Welcome to the Investing Ahead podcast. I'm Tom Curran. I'm pleased to have with me today Alexis Meeks, who is our tax manager at Hippo Tax Services. It's an affiliated company to Curran Wealth Management, where we prepare personal income taxes for our clients. Alexis is a CPA, and she's been in charge of that since we started it in reality about 5 years ago now. Is it 5 years? So I always thought that one of the challenges people have is understanding not just what their tax returns included, but after tax returns. So often I say it doesn't really matter how much you earn, it's how much you keep. IRAs came along, and I think they help people understand a lot that you kept it all. And it made us understand that in our taxable accounts, we don't keep it all. We have to pay taxes, and that becomes important. And then the tax laws got increasingly complex, and we spiraled into a grayer and grayer and deeper and dark cloud about what we really pay in taxes and what we keep. And so Alexis came along. We hired her. It was one of the better things I've done in terms of tweaking Curran Wealth Management. So Alexis, you know that I get frustrated because I look out and I see people and clients, and I want to help them. And I find that I find it difficult to make it understandable. So in your background, Alexis, you've been a CPA, practicing accountant since you graduated from college.
Correct.
How do you see people in terms of the way they view their taxes? Do you think that the financial services industry is meeting the needs at an educational level, or are they not simply, but are we more preparing the taxes and not educating perhaps as much as we could?
Well, I think for us as an organization, we're educating a lot more than what you see other people doing. Just given the fact that I'm in-house and meeting with clients on a regular basis and being part of the conversation helps them to understand that overall taxes aren't just a one-time a year situation, especially when you're dealing with life-changing events, whether it's retirement or, having a child, getting married, things of that nature. They change your tax situation, and it's not just at the end of the year that happens. So being involved in those meetings help people understand, like, hey, I need to get in contact with my tax professional a little more regularly, let them know what's going on, what life changes are happening, and things of that nature. And I think we do a really good job of that by, again, involving me in meetings, talking about, what are capital gains? What does that mean to me? I'm not going to see that money, but I know I'm making that money. And then obviously I'm going to have to pay tax on it. And that is not something people enjoy seeing at the end of the year when their tax return is prepared. So the more apt we are to let them know in advance, the better and well positioned they'll be to take care of it throughout the year.
Well, you've addressed a number of the things that we talked about early on when you joined us. One of the things I would say about taxes is, at least my experience before you, was that taxes became a kind of an annual event. We gathered the paperwork, we submitted it, and it was almost like a transaction. And I was thinking, and Alexis agrees, that it's not a 1 month or 2 week event. It's really a 12-month event. And I would watch accounting firms, for example, enter the financial service business. And I would say, I understand why they're doing it. They know the clients. They know the financial background of the clients. But we know the clients on a 12-month basis. We don't meet with them once a year. So wouldn't it be better or possible for us to kind of reverse the trend? The trend of the industry is accountants getting into the wealth management business. We were in the wealth management business. Can't we position ourselves to be in the tax preparation business? It made perfect sense to me because we were geared up to service clients' needs 12 months out of the year. So the idea that Alexis was meeting with clients, that was a perfect. But culturally, in our organization, while we would talk about it, Alexis, we went from, Tom, I'm not in that many meetings. I need to be in more meetings, to Tom, I'm in so many meetings. So we're beginning to transition the concept where Alexis is now requested when we meet with our clients. Before it wasn't that way. Now it's taken a lot, quite a few years, but we haven't had that conversation of late,
Right.
like we used to have it.
That is correct.
Now, I think we've created a demand for a service, which I thought was there everywhere. Now we're making that need apparent. And so Alexis is busier than ever in meetings, probably would tell me next time I'm in too many meetings, and that's going to create a challenge for us. But Alexis, when you meet with our clients, can you compare that a little bit to what it might have been like when you met with a client as a CPA only and not linked to how much money is a client making and how much tax are they making, and is there anything we can do on the investment side to mitigate taxes?
Absolutely. I would say it is very different than meetings I've had outside of our firm. A lot of times, again, it's very transactional. Oftentimes at a CPA firm, it's, you're bringing in your documents, we're preparing a tax return, or you have a situation come up, we answer the question and we move on. Within these meetings, there's a lot more focus on, the things that I need to be doing throughout the year that are going to set me up better for what my taxes are going to be, or, what my estate is going to look like, what things are going to be moved around so that, if charitable giving is important to you, that's a big hot topic right now for people, is how can I, leave a legacy? How can I, utilize my funds to give better, or things of that nature? Those aren't things you often hear about when you're working in a CPA firm. What kind of retirement plan is best for me? Should, if I own a business, which one of the many different retirement plans can I set up? What's going to give the best for me? What's going to do the best for my employees? Things of that nature. They're not topics that you typically see a lot within the CPA firm. It may come up, but it's not as top of mind as it is, within our company.
I had a conversation with one of our colleagues in Curran Wealth Management yesterday, as a matter of fact. And the issue came up over estate planning. And the bottom line was, from a reducing estate tax point of view, the strategy to be used was charitable giving. But from the beneficiary point of view, along with, in this case, the mother, the question was, to the point, which strategy do I get the most money? Which strategy does the child, in this case, get the most money? And that was, of course, direct gift to the child. From a tax point of view, the taxes would be reduced by giving the money away, but that money being given away, of course, doesn't go to the child. Well, that is a common sense, no nonsense, realistic, reality-based decision. But I can tell you that in all the years I've been in the business, I only recall a conversation quite like that in my entire career yesterday. And I can't help but think it's because we're dealing with it in a more comprehensive, broader fashion. And that is sometimes, if you go to a lawyer, you're going to get the legal opinion. If you go to the accountant, you'll get the accountant opinion. And if you go to us, while someone's alive, I'm going to say you're going to get an investment biased position. But the challenge for us people is, well, I need the best of that for when I'm not here now, for a period when I'm not going to be making the exact decision. And while it's common sense when we think about it, it's often missed. Now, I'm not trying to take away from philanthropists or any of that, but it's easy to determine how to reduce your taxes. It's quite another thing how to meet all your objectives. And again, depending on the size of an estate, that of course is going to depend. You could be talking about a few thousand, $100,000 to millions and millions of dollars, but it's still something that we think is common sense, but it may not be. So we try to get at that. And Alexis has done a really good job of not just helping our clients, but helping our wealth managers understand the more comprehensive approach to it. So do you think the average taxpayer takes advantage of most, if not all, tax-advantaged investing? Now, we know about Roths and IRAs, but beyond that, do you think they understand the implication, for example, of the cap on state and local taxes?
As far as itemized deductions, yes. I think people have become much more familiar with it only because now they're not really itemizing. They're taking the standard deduction primarily where we are in New York State because of that cap on the state and local income tax deduction. And I think that's also part of why charitable giving has become more of a topic to people, because in the past, what they've seen is my taxes go down when I give to charity. But if you're not itemizing and you're just giving directly to charities, that's not always the case. So you're going to see people that are wanting to put all of their investments in 1 year, skip a year and go that route. And that helps them to go over the threshold of a standard deduction and be able to itemize. You also see, more people opening up donor advised funds because you can take a big chunk in 1 year and have some carryover items that would help you to itemize in the future. But I do think there's a lot more, people are a lot more, understanding of that situation now versus where they were in the past. It was just an assumption of, well, I'm always going to meet this target. I'm going to exceed this target. But one of the things people also have to consider is how far over are you going to go? So maybe your itemized deductions are $14,000 and your typical situation, you're already going to get $13,700. So you're only getting a small piece of any sort of extra tax advantage to it. So it's important to try to utilize the system and make sure, maybe 1 year you take the standard deduction and you front load or back load all of the deductions that you think you're going to have into a separate year to take advantage of that. And I think our clients are a little more aware of that than what you're talking about as the average taxpayer. The average taxpayer is going to take the standard deduction because that's what's primarily available to them right now.
I think people listening to this are probably hearing a lot of what you're saying, Alexis, and saying, I don't understand that. And that's too bad. It's not that you have to understand it, but you have to understand how it impacts you. I'll give you an example. When interest rates were quite low and you could get a mortgage for 3%, the cap on interest wasn't as important because the interest rate was 3%. But at 7%, that cap is increasingly important. So the way I always looked at a house, and the way I would try to counsel people is the cost of your house is not pre-tax, it's after-tax. Because the cost, let's say the interest expense, is deductible. And if you're in whatever tax bracket, you're deducting that. So on an after-tax basis, the house isn't costing you as much as it is on a cash flow monthly outgo. Okay, that's understood. But is it understood that with caps, that sort of thinking isn't going to apply anymore? What is the maximum interest deduction you can make now on a house?
So the interest itself isn't particularly capped unless you're buying a house that's over a certain value. Then you have to you have to put it into a formula to decide how much of that is going to be deductible. Interest itself on a typical homeowner is going to be fully deductible, with the exception of, again, they're probably not itemizing, so they're getting no deduction for it.
Okay. So if someone buys a house and they are paying, let's say, on a purchase 7%, they can deduct that interest to a maximum of what mortgage amount? Is it 500,000?
I believe it's 750.
750.
Don't quote me.
So for the high income, high mortgage, they can still deduct to the cap, but that interest they're paying over and above the cap is costing them a whole lot more. Correct. Because it's not deductible.
Correct.
Those are the kinds of things that are very important. More important is that let's say the investor, homeowner who is being impacted by, let's say, inflation. They're also being impacted, while not on an immediate basis, any caps on state and local taxes, because it's not as beneficial to them any longer.
Correct.
So the house, even though they may be living in the very same house, paying exactly the same interest rate, the house is costing them more. Those are the kinds of things that I think, I don't think about. I think about them in the sense that I definitely want to know what I'm doing and what something is costing me on an after-tax basis. But I don't want to get involved in the nitty-gritty of all that, how that works. Can I do this? Can I not do that? Alexis and I were talking about something the other day having to do with the Wall Street Journal ran a story about the 4 most missed tax benefits for people over the age of 65. And I was surprised to read one that may or may not apply to me, but I was surprised to read that if, and you can clarify this, a working spouse over the age of 65, a non-working spouse, not working, doesn't matter what their age is, they can have an IRA based on the working spouse's income. And I said, wow, we have a lot of people working now where their spouses aren't that could do that. I wonder how many are doing that. And these are the kinds of things that come up from time to time. And I'll run to Alexis and say, Alexis, am I missing this one? Is this something I can do for my own benefit? And the answer may be yes or maybe no. But how often do you think those kinds of things happen, Alexis, on an individual taxpayer?
They're probably fairly common. Again, a lot of them are income driven. So when you come to me and ask if you're missing out, my answer is usually no. You don't usually qualify for them, but there are plenty of people, the example that you just gave, where, there's only one family member that's working and the other family is either retired or doesn't work, and they're not aware of where they can save and things they can do to put money away for the future, things of that nature. And that is definitely something that's missed by a lot of people.
So I think it's fair to say that if we wait to a couple weeks before the time comes for filing our taxes and we try to get all this together, we probably don't have much time to think about topics like we've just discussed. Do I qualify? And sometimes I think I've become an advocate of taxes and wealth management being merged, because so many of the consequences of an investment are after tax. And so much of the incremental tax a client may pay is based on their investment account, not their earnings. And that, I think, isn't really understood. So, Alexis, and I've never asked you this question, and I want you to answer it honestly, not because I'm sitting here, if you can do that. Do you think what are the benefits to having your taxes done by the firm that's also overseeing your investments?
I believe there's a lot. And the biggest one is just that I see what's happening in your, investments, in your retirement accounts, in all of the background stuff throughout the year. I see from, January to December exactly what's happening. I, recently read an article talking about how, talking to your accountant during the year is more about planning and discussing situations. If you try to talk to them January, February, it's a transactional situation. So for us, where we are, a lot of it's more planning, making sure you're set up so that there's no surprises when it does become transactional. It's still transactional for me during those months because that's where we're preparing the returns. The difference is that the people know and they can expect where they're going to stand and what it's going to look like. And throughout the year, they're going to have questions about, the investment side of things. And a lot of times their wealth manager can answer them fairly efficiently, but sometimes it's nice to hear it from another resource that, maybe has a different look on it, maybe has a different opinion on it. And then they can, take both and make the best decision based on those two examples.
Now let's flip it. Advantages to doing it the conventional way: separate tax accountant, separate wealth managers.
I mean, I don't know that there's an advantage to that. That's just how the system is set up in most situations. Mm-hmm. Again, I've always looked at, working in the CPA business as a very transactional, from an individual tax return point of view. It's certainly different if you're, running a business and we have to do things throughout the year in that sense of it. And we do very little of that where we are. But from a purely individual tax return point of view, it's very transactional. And again, talking about the benefit of it, trying to coordinate it, an external accountant and an investment advisor so that we all have the same information so that we can, share things readily. It becomes a little more complicated. And so the communication is far less.
Okay. We talked a little bit about this, and this is a little bit off topic, but why are fewer people going into accounting? I'm reading the college enrollments in accounting are declining. Albany State, I just read where theirs is down. Siena Colleges is down. Why is that?
Well, I mean, it's not a terribly exciting career. Okay. So there's different theories on, personalities that work well in accounting and others that don't. Tax season, it's not fun. It's not, there's nothing about a traditional tax season that is great to somebody from the outside looking in. Nobody's going to want to put in the amount of hours. It's a short season. So the amount of hours there is not something that's appealing to people. They have changed the education system where it becomes you have to have a master's now just to sit for the CPA exam. So instead of looking at a 4-year degree, you have to go for 5 just to sit for the CPA exam. So there's, some hurdles that are there. And I think if I was to wager what it is most, it's tax season.
Okay.
And I don't know that there's a way to change that from a government perspective. But I think those hours are a drain for people.
And I think, and again, I don't know if this is an advantage for you or not, but being in a wealth management firm, providing tax services, that off-season, height of the season, tax crunch time, you have to experience that for sure, but we now use your talents and what you do so well for the benefit of our clients in terms of 12-month planning, whereas an accounting firm might divert that talent to audits or corporate functions away from the individual. And that's one of the reasons why I think our approach is, really maximizes the benefits, because it doesn't take those hours and divert them someplace else. It gets them to be able to focus on the client a little bit more. Let me ask you this, Alexis. When you first started, we talked about the frustrations of kind of being the outsider, not being included, not being, when tax situation questions came up, being outside all that. And we talked earlier that that's changed a lot. And I think we've benefited from that. I think our wealth managers now understand tax is different than investments, is different than estate planning. So I feel that, and that's very, very gratifying. I kidded Alexis. This has been one of my challenges for quite a few years, and we hired a tax lawyer at one time to be a consultant for the benefit of our clients before we had the tax services. And he was a contract worker. We brought him in a couple days a week, and the idea was we'd integrate him. And we tried this for more than a few years, and finally it was a failed experiment. He came to me one day and he said, "Tom, I'm just taking your money. I'm not being utilized. I'm not being used." And we stuck with it and kept trying, and now we have Alexis and Hippo Tax Services, and now we're seeing the demand, where it seemed to be, in the words of my that person who's now retired and was a very valued employee, became a valued employee of mine after he was a consultant. He joined us full time. The failed attempt. So it was probably more the third attempt that we finally got it right, and I'm pleased with that. And I have a feeling that going forward, Alexis, we're going to see more and more of our competitors copying what we've done, but they now are facing the challenge accounting firms are facing. That is, where are you going to find an accountant? It's a critical need in the country. So any of you who have children who are looking to find a career where the demand is up and the supply is down, accounting is probably one of those. Alexis, one last question. And again, this is unfair of me.
Oh, great.
But I'm pretty sure I know what the answer is. But do you believe that at Curran we are innovative, and in terms of the software we employ, the software we use, the attempts we make, even though we might fail at first, to have clients appreciate something that we agree professionally is important, but they may not see that we don't run away from it just because it doesn't sell, or because nobody comes to the meeting that we have, or we continue to hammer away even if it's a loss leader trying to get it done.
I do. I believe when I started, maybe that wasn't as much the case. I think over the years, it has definitely changed. There's a lot more in place. I think there's a lot that clients don't necessarily even understand what's in place. They just see it and know it and take it for granted that that's how we do things there. And I do think, as an organization, we're definitely on the leading edge now with our technology, with what we bring to the clients, with what we're willing to try. And those sorts of things.
Well, thank you. Alexis Meeks is our tax manager at Hippo Tax Services. She's a CPA, and she's a valued contributor to all that we do at Curran Wealth Management. Thank you, Alexis. I thank you for watching this podcast. This is Tom Curran. Goodbye with thanks.
Thank you for watching and listening to the Investing Ahead podcast with Tom Curran. Look for the Investing Ahead book and audiobook available everywhere. Executive producer Brendan Kennedy. Directed and produced by John Wager. Engineered and edited by Adam Russell and Edith Fitzsimmons. Filmed and recorded at Galileo Media Arts Studios. Copyright 2024 Thomas Curran. All rights reserved. For more information, visit investingaheadpodcast.com.